Can you hear me? Okay,
Yes.
so guys,
Yeah.
we are going to everybody, just so I'm real clear, everybody who said they were here will receive 100% on the quiz, the review, thanks to Lorena, and the homework. And because you're here, you were able to opt out of the final. And I have written those of you who opted out, and then those of you who are taking the final, that could increase your grade. Okay, that could make your grade better because, well, you understand. Okay, let me just check the messages. Yes, 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 found it. How to unmute, found it. Okay, is that okay? Does everyone understand that? So I want to start by saying it's been a delight to have you all. I hope this has been a beneficial class for you. I hope that I've been a decent instructor. As I've said before, I welcome your feedback. I don't hold it against you. I welcome your honest feedback because you will only help me improve in future semesters. One thing I did realize in this class, so for spring semester, if you take my managerial, I am going to, instead of having a midterm and a final, I'm going to do three tri exams. So chapters 1, 2, 3, 4, then there's an exam, 5, 6, 7, 8, an exam, just to make them a little more palatable so they're not so intense, filled with so much. So that's one change I am making, but I do welcome your feedback. Okay, so guys, we're going to start. As you know, every time we had a chapter, at the end of the chapter, they had ratios, and I kept saying, you guys can do that on your own because we're going to go through them at the end of the class. And this is where all the ratios we're going to discuss. So this chapter deals with what we call financial statement analysis. And really what we're doing is we're taking these ratios and then what we call horizontal and vertical analysis because we want to make sense of financial information. We can look at financial information between companies in the same sector. So, for example, we can compare sales or costs between companies in the same sector, such as Under Armour or Nike. Now, granted, as we'll see, Under Armour is a much smaller company than Nike, but you can still, because they're in the same line, the same type of entity, type of business, they provide the same type of goods. It's helpful to gather information between companies. Or we can take one company and compare the sales with its, sales in previous years. So one is among different companies, one is the same company over a period of years. Or we can compare Under Armour to the industry average. So all of those types of companies that are in the same line of work are the same entity, Nike, guys, what are some others? Adidas. You can compare with an industry average. So vertical analysis is where we're going to create a percentage, each item in a financial statement. So if we're dealing with an income statement, all items will be expressed in sales. Sales being 100%, all the other items are a percentage of the sales figure. if we're dealing with the balance sheet, we will express all items related to total assets or all items related to total liabilities and stockholders' equity, because we know assets equal. Remember from the first time you guys came, how many weeks ago? Assets equal liabilities plus stockholders' equity. Look how much you guys have learned in 3 months. 3 months. So here we're looking at Under Armour and we're looking at Nike. This is an income statement. Under Armour's net sales were 3,084 million, let's say. That is 100%. That sales is 100% for Under Armour. Then if we look at the cost of goods sold, we take that 1,572,000,000 divided by 3,084,000,000 to come up with 51%. The gross profit, we take the 1,512,000,000, divide that by the 3,084,000,000. Do you see what we're doing? Net income, 208 million divided by the 3,084,000,000 is the 6.7%. The same with Nike. Now you see Nike sales are 10 times that of, almost 10 times, 9 times that of Under Armour. Much bigger company. And then again, for Nike, all those line items, we would divide by this Nike sales figure to come up with the percentages. Does everyone understand what I'm talking about right now? I'm just going to look at the chat real quick. Stockholders' equity plus liability. Yes. Okay, sorry guys, I just wanted to make sure I'm listening to your feedback. Okay, so you see again, what we did is with cost of goods, we take the 1,572, divide that by the 3,084 to come up with our percentages. And again, we start at sales, we end up at the net income. We see here Under Armour was at 6.7% net income to sales, and Nike was at 9.7%. So it looks as though, in this case, Nike's profitability is better. You know, you can't, all of these analyses are helpful, but you just can't take one on its own. Now, in the balance sheet, again, the 100% will be the assets, total assets, or total liabilities and stockholders' equity. That's the 100%. And all the line items, we divide by that 100% figure, the assets or the liabilities and stockholders' equity. And again, we see that Nike's assets are about 9 times that of Under Armour. So as far as assets go, their current assets are sitting at 73%. Their liabilities, that's a big one. Under Armour's current liabilities are at 20%, whereas Nike's are sitting at 27%. Nike's common stock, it's a larger company. They've got more common stock, where Under Armour, to me, their retained earnings, they've held on to it. They're not paying out the dividends that Nike possibly has paid out. I mean, I'm kind of talking my thoughts out loud here. There's so many different things we can look into this company, but clearly with Nike, their current liabilities are greater than Under Armour, which can, basically they need the cash on hand to pay off those current liabilities as they come due. Okay, again, the key here is when we do these analysis, we we compare all figures to total assets, okay? With vertical analysis, we express each item as a percentage of the same base amount, such as a percentage of sales in the income statement or as a percentage of total assets in the balance sheet. So if we look at this exercise, we have the Federer Sports Apparel, and we have all the figures, and the goal is to do a vertical analysis. So the way we would do that vertical analysis is our sales would be at 100%. So for 2019, we would have the sales figure at 100%, same with 2018, sales at 100, and then all figures would be related to based on those sales. So you see here, I mean, I'm just kind of sharing with you things that I think are odd. Cost of goods sold here in 2019 is 70% of sales. Cost of goods sold in 2018 is 45% of sales. That does not jive. So did they maybe write off a bunch of bad inventory in 19? Do you guys trying to see what I'm talking about? Their gross profit in 18 was 54% versus 19, 29.8. That is extremely significant numbers. Net income. How can in one year it be at 25.8% and then in another year it's at 4.5%? Clearly, it's in this cost of goods sold. So I'm just kind of putting some thoughts out there. When using vertical analysis, we express income statement items as a percentage of, what's it going to be, Lorena?
Net income. A sales, sorry.
It's okay. I had to pick on you. You know,
Okay,
I told you all along I wasn't going to pick on anyone. I get to pick on you now because you're already going to get 100%. When vertical analysis, we express balance sheet items as a percentage of. Isabella, since my grandson liked talking to you so much, I'm going to pick on you.
A.
Hey, Isabella, you rock. Excellent. Now, when we talk about horizontal analysis, so someone can turn off their speaker again. Sorry.
Before you withdraw class. You're thinking of withdrawing from a class or have already decided to withdraw.
Can someone tell their
from a college course? What does it mean? What is the impact?
I think it's Angelea that has the volume on.
Who does?
Angelea.
Angelea, you're listening to something else. Can you turn it off? Thank you. Okay, so performing horizontal analysis. Angelea, I didn't mean to yell at you. It's just, it went on and it was frustrating. Or it was interfering. How about that? Horizontal analysis. Now, in this case, we analyze trends in financial statement data for one company over a period of time. So the way in which we do this, we take the current year. Now, granted, this slide shows 2014, but that's the most current year. So we take the current year and then we compare it to the previous year. So the 3,084 minus the 2,332, the difference is $752. You see? So we take the current year amount from the prior year amount and we divide it by the prior year amount to come up with these figures. So as you see here, by doing that, the increase in Under Armour from one year to the next is an increase of 32%. With cost of goods sold, we take the 1,572 minus the 1,195 is the 377. We divide that by 1,195 to get 31%. As you see, if we have other expenses, 12 minus 4 gives us 8. And that figure, 8 divided by 4, has gone up 200%. Okay, do you see how we're doing that? This is what we call horizontal analysis, comparing between the years of the same company. Okay, so you see that we're going to look at 2 years. We're going to take the difference between those 2 years, divide it from that prior year to come up with the figures. So here, when we're dealing with Under Armour between 2 years, this is what we call horizontal analysis. Our assets have increased 32.8% from 1 year to the next. Okay. We use horizontal analysis to analyze trends in financial statement data, such as the amount of change and the percentage change for one company over time. So again, we'll do a exercise regarding horizontal analysis. We've got Federer Sports Apparel. We've got 2 years. To do a horizontal analysis, we would just, the 18.8 minus the 15.5 is the 3,300,000. Divide that by 15.5 gives us our 21.3%. Does that make sense, guys? You see their net income went down 78.8%. That's pretty darn significant. So who can I pick on? Now, Nodder? Nate? No. Trevor. Horizontal analysis examines trends. I don't think Trevor was here. Summer, you're going to get picked on this one. Horizontal analysis examines trends what? For a single company over time, right? Does that make sense? Now, we're going to spend the next portion talking about ratios. Remember all those ratios you had at the end of all those chapters that I kept telling you, let's wait. There are ratios for different purposes, but we're going to start with risk purposes, which is what is really significant if you're interested in investing in a company. In comparing an income statement account with a balance sheet account, some students incorrectly use the balance sheet account's ending balances rather than the average of its beginning and ending balances. Since income statement accounts are measured over a period of time, comparisons to related balance sheet accounts need to also be over time, and you average the beginning and ending balances. So in this case, if we've got Under Armour, we've got the income statement, and here we have the balance sheet. We're not going to just take the figures from 1 year, from one day. We're going to compare them, or we're going to come up with an average. So when we're dealing with current assets, we would take the 1549 plus the 1129 divided by 2 to come up with an average, because we know a balance sheet is a snapshot in time. And just that snapshot, those are the figures. If we take the beginning or the figures from 13, and we take the figures from 14, divide them by 2, we come up with an average. Now, our ratios related to risk deal with liquidity and solvency. You see, liquidity ratios regard to how they're able to convert their receivables into cash, how quickly they turn over their inventory, and the ratio, current ratio and asset test ratio shows, do they have the ability to pay their debts as they come due? So no, these liquidity ratios, and this is a really helpful slide. So when you're required to do a ratio, if you choose to take the final, use the sheet to know your calculations. Now, again, average accounts receivable, you're going to take those 2 years and average them. And then you see the average collection period. So receivables turnover ratio, how soon do you collect your receivables? And then you can figure that out in period of days, the period in which those come in. Inventory ratio. We don't want to hold inventory on hand because inventory is money, costs money to sit there. And so, and there's a balance to that too. You want to make sure you have the goods on hand when someone wants to buy them. But there's a fine line of being smart with your cash and making sure that inventory comes in, goes out right away. So we've got the inventory turnover ratio and average days in inventory. The current ratio and the asset test ratio show your ability to pay your current liabilities as they come due. We know that the asset test ratio is more stringent than the current ratio because the current ratio deals with all current assets, but the asset test ratio really deals with those you're really converting to cash right away. Cash, current investments, and accounts receivable. Solvency ratios deal with, is this company going to remain in business? Do they have the means to continue as a going concern? Debt to equity, the total liabilities divided by stockholders' equity. And then the times interest earned ratio. Take the net income and the interest expense and tax expense and divide that by your interest expense. So when you look at the receivables turnover ratio, you take the net credit sales and you divide that by the average accounts receivable. So you see Under Armour turns their inventory over 10.6, excuse me, not inventory, receivables. Under Armour receives their accounts receivable 10.6 times in a year. Nike receives, collects their receivables 7.7 times in a year. Basically, which would be better? Is a higher ratio better than a lower ratio in this one? Yes, it is. A higher ratio is better because it indicates the ability to turn those receivables into cash quicker. A low ratio indicates they're having a harder time getting those receivables collected into cash. This just shows you in the number of days. Under Armour collects their receivables every 34 days, where Nike's every 47 days. Which is better, a longer or a shorter collection period? Well, of course, a shorter collection period is more desirable. They're getting their money sooner. Inventory turnover, the same concept. Under Armour, excuse me, the Under Armour is not turning their inventory over as quickly as Nike is. A higher ratio indicates inventory selling quickly. But it says here an extremely high ratio might indicate lost sales because there's not the inventory on hand. So you got to be fine there. So Nike turns its inventory over every 89 days, where Under Armour's every 117 days. Again, you want a shorter period because that shows the inventory's going out quicker. Current ratio, if under the current assets to the current liabilities, Under Armour sitting at 3.7 to 1 and Nike's at 2.7 to 1. which is more desirable? You want a higher current ratio because it shows you've got assets to cover your liabilities when they come due. Okay, your current obligations, current liabilities. Asset test is a little more stringent, more conservative. Again, Under Armour sitting at 2.2 to Nike's 1.8. You want a higher one. Now, in terms of solvency, the liabilities to stockholders' equity, Under Armour sitting at 55%, Nike's at 71.8%. Would a higher debt to equity ratio indicate lower or higher risk? Who wants to take this, guys? Kirsten, what do you think? Who do you think's at greater risk here? I think Nike is, guys. The higher the obligations, the higher the risk. Okay. So a 71.8 debt to equity is a little scarier than Under Armour's 55.2. I shouldn't use the word scarier, has higher risk. Okay. Times interest earned compares interest payments with income available to pay them. What's better, a higher or lower? The company wants higher net income before interest and taxes in relation to the amount it needs for interest expense alone. So Nike is more desirable in this ratio. Okay, so again, these are liquidity ratios and solvency ratios. They're risk ratios. Which of the following here is considered a liquidity ratio? Anyone?
C.
Excellent. C. Who wants to take this one? Which of the following is considered a solvency ratio?
D.
Excellent. D. Solvency D. So again, we've got some income, an example here with Adrian Express. And to come up with the various ratios, you take the figures on the balance sheet. You're going to come up with averages. And we know how to come up with our various ratios. Okay. Now, regarding profitability, these are the ratios. How profitable is a company? The gross profit ratio indicates the portion of each dollar of sales above its cost of goods sold. So Under Armour is sitting at 49%. Nike is sitting at 44.8%. In this case, it looks like from this ratio comparing, Under Armour looks like the gross profit ratio is more favorable than Nike. Do you guys believe gross profit ratios vary by industry? Think of this. Think of a jewelry store versus a Walmart or just a grocery store. Do you think a grocery store has gross profit ratios similar to a jewelry store? No, they're not going to. Why? Because the profit margin on an apple is going to be tiny. The profit margin on a piece of jewelry is going to be huge. Okay. And so they are going to vary among industry. Return on assets. Here we take our net income divided by our average total assets. This measures the income the company earns on each dollar invested in assets. Under Armour sitting at 11.3 and Nike sitting at 14.9. Which is better? A higher percentage or a lower? Wouldn't a higher be better? It indicates a higher amount earned compared to the assets it owns. Now, return on assets. Guys, am I going too fast? Please tell me if I am. Return on assets is made up of profit margin times asset turnover. Profit margin is your net income to sales. Asset turnover is your net sales to average total assets. Do you see, guys? If you took out the net sales piece on each side, you've got the net income divided by average total assets. See that? Some companies rely on high profit margins. Other companies rely on more asset turnover. Investors desire companies that can maximize both. Okay? Some focus on profit margin. Okay? Some are just trying to get assets turnover high. Profit margin measures the income earned on each dollar of sales. So the net income to sales, if Under Armour's sitting at 6.7 and Nike's at 9.7, which is more desirable? A higher profit margin indicates a higher amount actually earned after the expenses are accounted for. Okay? That includes all expenses. Asset turnover measures the sales volume in relationship to our total assets. Here, Under Armour sitting at 1.7, Nike's at 1.5, pretty darn close. You'd want a higher ratio. A higher ratio means a company has more revenues compared to each dollar invested in their assets. Return on equity measures the income earned for each dollar in stockholders' equity. We take our net income, we divide that by our average stockholders' equity. Now, guys, what do you think of this? Nike's sitting at 24.6%, where Under Armour's at 17.3%. You think it's better for it to be higher or lower? Higher. A higher amount earned compared to the investment made by the owners of the company is more desirable. Their money's being put to use, providing better return. Compares a company's price earnings ratio, compares a company's share price with its earnings per share. So this is interesting. This is pretty different. Under Armour, the stock price to the earnings per share shows 69.3 price earnings ratio to Nike's 25.2. A higher ratio here indicates that investors have a higher expectation of future earnings for this company. So people think here Under Armour is going to grow, okay, and do well. These profitability ratios measure the earnings or the operating effectiveness of a company. Investors view profitability as the #1 measure of a company's success. Remember that, guys. Huge. Those profitability ratios are really what drive investors. So again, we look at an exercise and have this information. We can then come up with various ratios. Okay. Guys, who wants to take this one? The sports zone reports net income of 50,000, net sales of 500,000, and average total assets of 400,000. What is the asset turnover? I'm going to go get another Diet Coke. I'll be right back. Who wants to take this one, guys? Should I call in Victoria?
C.
See? Excellent, guys. How about this one? The sports zone reports net income of 50,000, net sales of 500,000, and average total assets of 400,000. What is the profit margin? Hui, you want to take this one?
Okay, profit margin. So 10%.
What?
The answer A, 10%.
10%. Thank you so much, Hui. Excellent, guys. Okay, who's next? The sports zone reports net income of 50,000, sales of 500,000, and average assets of 400,000. What is their return on assets? Anyone?
Excellent.
12.5%. Then we're going to talk about good types of earnings. So the goal of a company is to do well at why they're in business. Sometimes there are events that create income, such as selling off a sector of the business or selling off some assets. One-time income items are just certain items are part of the net income in the current year, but they're not going to persist every year. Earnings persistence or where current earnings will continue or persist into future years. That's what you want. Discontinued operations, sale or disposal of a significant component. They could do a line of business, an investment, or a geographical. And they could have gains or losses regarding that. When there is a discontinued operation, the company has to report that in a separate item in the financial statement. But it's really important to be able to distinguish why, in fact, the profits look so high in one year versus another. So on this particular one, we see a separate line item for discontinued operations. We keep it separate from the reason the company's in business. We've got other types of revenue and expenses, losses due to the write-down of receivables, inventory, or long-term assets, gains or losses on the sale of long-term assets, losses due to specific events that don't happen every year, employee strikes, business restructuring, or think of what happened when British Petroleum spilled oil in the Gulf of Mexico. I mean, every once in a while, you have just a freak thing that does affect the earnings. And, natural disasters can really affect a business. So basically, we have to be aware of unique items. So in this case, we're an auditor of a CPA firm, and we're responsible for determining the proper classification of income statement items in the audit of California Sports Grill. One of the company's restaurants was destroyed in a forest fire that raged through Southern California. Uninsured losses from the fire are estimated to be $450,000. We're going to put that as another expense. If California Grill has 3 operating divisions and the company sells the frozen retail foods division for a profit of $2.4 million, we're going to put that in a separate category, discontinued operations. An employee strike showed an expense of $200,000. We're going to put that in other expenses. The waiter slipped on the floor and he got a settlement, other expenses. They sold 1 restaurant, other revenues. Does that make sense? We're going to separate those one-time or unique events. So guys, who wants to take this one? Which of the following items would be reported at the bottom of the income statement just before net income? Isabella or Spoon? I think Samuel's here.
See?
See, excellent. Thank you. Now, we know through generally accepted accounting principles, GAAP, we have certain guidelines we are supposed to adhere to. We're supposed to be conservative in our approach, but not everyone is. Quality of your earnings talks about, are the earnings real? Are they true reflection of how the company has conducted business? When we have conservative practices, if we err, we're going to err with lower income, lower assets, and higher liabilities, because all 3 of those viewpoints protect the shareholders. Aggressive practices do the opposite. They're going to make them look better. Higher income, higher assets, and lower liabilities. It makes the company look better, but it can harm the shareholder. So no, aggressive practices could ultimately harm the shareholder, while conservative practices may not let the company look as profitable or successful, but are best for the public. So Mr. Nadel prepared financial statements here. And basically, here it talks about, different changes. So in this case, in 19, Mr. Nadel estimated that future bad debts will be 6 to 10% of current accounts receivable, but he wanted to play it safe and record an allowance equal to 10% or $150,000. Mr. Djokovic proposes changing the estimate to 6% or $90,000. Basically, again, there's a conservative approach and an aggressive approach. Writing down inventory, Nadel recorded a $200,000 write-down of inventory, but Djokovic insists the write-down wasn't necessary because the decline in inventory was only temporary. Do you understand how one person's doing it from a conservative approach where another one is doing it from an aggressive approach? I'm sorry about the noise, guys. I'm sorry, anybody who's listening to this video. I'm at my grandchildren's house, and it's just the way it is. Changes in depreciation. For the building purchased for 11 million in 18, Natal recorded depreciation of 1 million in 18 and 19 using the straight line method over 10 years. In 19, Djokovic proposes calculating depreciation over 20 years. So again, Djokovic's approach shows a lower depreciation expense, which means higher net income. See? Loss contingency. At the end of 19, the company's lawyer advised Natal that there's a 70% chance of losing a litigation suit. But Djokovic argues the likelihood is reasonably possible, which means in that case, he wouldn't have to report it. So you hear that with Natal, he's using a conservative approach. He's going to write off this loss, where Djokovic doesn't want to report it on the financial statement. As a result of either one, it would affect the financial statements significantly. Okay. As you see, Natal represents a conservative approach and Djokovic is an aggressive approach. So basically, guys, I know I went through that really fast. Any questions at all before we end? And I want you guys to email me. I will get the grades out for sure this weekend. I know for the next couple days it's kind of hectic around here, but if you have any questions, feel free to email me, guys. I check my emails quite often. Okay, guys? Anybody? And let me see if I can see. I'm just trying to see if I can see anybody. Any questions, guys? How's everyone doing? Are you doing okay? Yes? Good, everybody? Anyone have comments? Make sure you put them in the chat. I'm good, so we do not need to do the review, homework, or quiz this week. Caitlin, you are here. Did I mark you present? Did I mark you present? Yes. You don't have to do the homework, the review, or the quiz this week. Okay? You're fine. Okay? How's everyone doing? Guys, it's been a delight. I enjoyed this time. I hope to see you again. I hope I'll see you all taking managerial accounting. Who is taking managerial next semester?
I am.
Caitlin is.
I am.
Well, guys, blessings to you all. Please email me, okay? And I'm here to help you. Bye, guys.
Happy Thanksgiving.
Bless you all. Bye-bye.
Bye. Happy Thanksgiving.
Thank you, guys.